And look, somewhere right now in a beige office park you will never set foot in, an insurance adjuster just opened a file with your address on it. And they've already made a decision about your financial future that you have no idea happened yet. You see, your policy still says you're covered, but the check they'd actually write if a tornado relocated your roof 3 states over, that number's been cut quietly 3 times since you became a customer. They could keep cutting too, but they're not going to cancel you. That's the old playbook, and they got caught doing it. The new playbook is smarter, and it's worse. They keep you on the books. They keep cashing your checks. And they hollow out the policy from the inside, the way a wasp hollows out a caterpillar. So the day that you finally file, there's nothing left to pay you. You won't find out until the day you need it most. So I'm walking you through the 5 moves your insurer is using to strip your coverage while charging you full price for it. Number 4 is the one nobody catches until it's too late. And before you think you'll just switch carriers, 3 of these 5 are industry-wide. There's nowhere to run. They are slowly nuking your coverage behind closed doors, and they're not done. But you're not powerless either, so stay with me. Move number 1, the frozen limit. Your premium goes up every year, so it would make sense to assume the coverage went up too, right? More money, more protection? That's logical. It doesn't work that way. This is insurance, where logic goes to die in the fine print. There's a line on your policy called Coverage A, Dwelling. That's the number that rebuilds your house from the ground up. And that number and the number you pay are 2 different dials. One climbs every year like it's training for Everest. The other just sits there, frozen. Picture an umbrella. Every year you renew, somebody quietly snips a few threads out of it. It still opens, still looks fine by the door. And you only ever find the holes when it's actually raining. And the rain is the day you file a claim. Here's the damage. Prices rose about 47% from 2020 to 2025. The average is now over $2,800 a year. But the dwelling limit, it barely moved. Which is why right now, 2 out of 3 American homes are underinsured by an average of 20% or more. And there's a clause that makes it worse. Fall below 80% of your rebuild cost, and they short you on the small claims too. It's called a co-insurance penalty. You know, after the Marshall Fire in Colorado, entire neighborhoods gone. 74% of homeowners were underinsured. The average gap was $139,000 out of pocket from people who paid every bill on time. So first move, and just hold it, we'll do them all at the end. Go find Coverage A on your policy and make a note of it. The frozen limit is the slow leak. This next one's a hole they cut on purpose in the most expensive part of your house. Move number 2, the roof schedule switch. And yeah, we're talking about your roof. So how does a policy that says replacement cost right on the front hand you a depreciated check? Because the roof page is a different broken promise. Carriers quietly attach an actual cash value clause that ages your roof like a used car and pays you what it's worth today, not what a new one would cost. Allstate led it. Farm Bureau and American Family followed. Replacement cost is on page 1. Depreciation buried on page 6. Different pages, different promises, same company, same premium. So here's the math. If you got a 15-year-old roof, say it's $20,000 to replace it, but they depreciated it about 50%. So the check's $10,000 minus your deductible. Harsher schedules knock off 60 to 70%. So your $20,000 roof pays out $5,000. So they didn't cancel you. They just decided your roof is worth a 2008 Honda Civic with a busted transmission. And the industry's own trade group basically admitted why. They complained that a company with homeowners getting 3 $20,000 roofs in 3 years, that's not a sustainable business model for them at $1,100 a year that you're paying. Which is corporate speak for, we changed the deal because the old deal cost us money. And we hated that. So next, find the words loss settlement on your roof. Is it a replacement cost or is it an actual cash value? And real quick, 2 of these 5 are carrier specific, the stuff that you can actually shop. So there's a questionnaire in the description below to see if you're overpaying another company for the same hollowed out coverage. Check it out when we're done here, but it won't fix what's coming next, yet there's no reason to overpay on what you do control. Now those 2 you could at least spot if you went looking. This next one you don't see coming because it's not about your house, it's your whole zip code. Move number 3, the non-renewal map. What happens when they don't raise your rate at all and just decide not to renew you? So I know what you're thinking. That's a Florida thing or that's a California thing. Hold on. I pulled the data and it's not. In December 2024, the U.S. Senate Budget Committee pulled county-level records from 23 insurers, about 65% of the whole market across all 50 states. What they found, 1.9 million policies not renewed. In Florida, the rate nearly tripled. But this contagious corporate cowardice is not staying in the disaster states. The report names the Carolinas, New England, Oklahoma, the Northern Rockies, Hawaii. The federal government built a map, and there is a real chance your county is glowing red on it right now. So go find your county and see. It's public. That link's in the description too. The next one, they bury in language designed so you won't catch it. It's the one I warned you about in the beginning. Move number 4, the mismatch clause. How can you be fully covered and still end up in a two-toned house that looks like a failed art project? Hail dents the siding on one side. The adjuster replaces that side. But your siding's been discontinued since 2014. The new panels, they don't match, and they won't pay to fix the rest. So now you're beige on 3 sides, bone white on the 4th. You were covered. You're also a permanent cautionary tale at the neighborhood barbecue. That's the matching loophole. And carriers now slip in cosmetic damage exclusions to make it stick. And the fix, the promise that your house will match, which used to come standard. They'll magnanimously sell it back to you for about $25 a year. $25 to unbreak a promise you thought you already paid for. And your wind and hail deductible is often a percentage now, 1 to 5% of your home's value. On a $400,000 house, that's a $4,000 to $20,000 deductible before they pay a dime. A deductible bigger than the claim most of the time. That's not an accident, that's the design. 4 ways they've shrunk what you're owed. And I'll show you how you can fight back in just a minute, but before the 5th move they're taking, the creepiest one, you need to know why they're doing all of this. Well, here it is. And I want to give you the honest and fair version first, because part of it is true. Their costs did go up. Insurers buy their own insurance, reinsurance, and the price of it roughly doubled for them between 2018 and 2023. 2023 set a record with $28 billion disasters. That's real, and I'm not going to pretend it isn't. But that's not where the story ends, because in 2024, while they were depreciating your roof and freezing your limit, the property insurance industry's profits nearly doubled. Their costs doubled, and their profits did too, to about $166 billion, with a B. Here's the line to text to your spouse. For every dollar you pay them in premium, only about 62 cents goes back out to pay claims. Used to be 70 to 80 cents. And yeah, you're hearing that correctly. They pay out less of your dollar than they used to and charge more for it. Their losses went up 40% since 2020. Their prices went up 52%. So no, please don't cry for them because their costs went up. They didn't hollow out your policy to scrape by and survive. No, they nuked it and posted record profits. And if this feels familiar, it should. Your parents had a pension. The company carried the risk. That quietly became a 401k, and the risk got handed to you. Same trick, new industry. Keep the brand name, keep your money, slide the risk onto your side of the table. Now, knowing they're not doing this to survive, they're doing it because they can. Here's their 5th move, the one where they keep a file on you. Move number 5, the claims score gatekeeper. What if just asking a question could be held against your house for 7 years? See, there's a database run by LexisNexis called a clue report, which is an ironic name for a file you don't have one of. It tracks your home's claim history for 7 years, and it follows the house, not just you. So a claim the previous owner filed before you had the keys can be sitting in your file right now, raising your rate on a report you've never seen. Now, to be straight with you, because this does get exaggerated online, officially, they're told not to log it when you just ask a coverage question. But call about a real problem, like a burst pipe, and even if they pay you nothing, that can get recorded as a claim. Some states had to pass laws banning rate hikes just for asking. So despite whether they can log your question as a claim or not, they had to pass a law. That's how real it is. But there's some good news here. Federal law gives you 1 free clue report a year. Pull the file they've been keeping on your house in the dark. If there's a mistake, fight it. So those are the 5 moves they're making. Now let me show you how the people who don't get squeezed handle all 5, and exactly what you do this week. Here's the thing, none of this is bad luck. It's a product tier. The wealthy don't have a secret insurance company. They just buy the high value policy, Chubb, pure AIG private client, and it's every single thing they strip out of yours, just sold back intact. Guaranteed replacement cost, no depreciation, no co-insurance penalty, no mismatched siding. Think of an airplane. Same plane, same engines, same destination. They paid for first class, bag included, seat reclines. You got moved to basic economy, where everything that used to come standard got unbundled and sold back one piece at a time. So the umbrella still opens. That's the trick. It still looks like protection. They're just betting you never check it for holes until it's already raining. So you've got two moves that you can make, just two. One, you keep auto paying, leave the policy in the drawer, and find out what's left in it on the worst day of your life, holding a $5,000 check for a $20,000 roof. Or two, you spend 30 minutes this week. 3 action steps. Action number 1, pull your declarations page and find 3 lines. Coverage A, does it rebuild your house at today's prices? In the roof loss settlement, is it replacement cost or actual cash value? And your wind and hail deductible, flat dollar or a percentage? 15 minutes and it's free. Action 2, request your free clue report from LexisNexis. Read what's on your address. Dispute what's wrong. Action 3, email your agent in writing, what's it cost to put real replacement cost back on my policy? And if my premium jumped, why? And get it in writing. You know, I've got a buddy who did exactly that last month and found out he'd been on an actual cash value roof for 3 years and never knew it. So 3 actions you can take. One afternoon, $0 to look. And really, while you're at it, you might as well shop around. I mentioned that questionnaire in the description to see if you're overpaying another company for the same coverage. If you find that you are, let your current provider know that you found a better deal somewhere else and ask them to match it or you're leaving. Listen, I know you and I are old school. We come from a time where loyalty is rewarded. Well, times have changed. Make them earn your business every year and make them compete for it. Yeah, their losses are up 40% since 2020, but their prices are also up by 52%. They're going to be just fine. So get yourself the best deal. In fact, there are homeowners right now cutting their bill 40 to 50% by deploying different methods and strategies to beat the rate hikes and protect their equity. And that's why I pulled this video out here for you to watch next. I put together the 4 most practical moves that they're making so you can cut your insurance bill too. And look, I know insurance is about as exciting as a box of hair. I know you'd rather do just about anything else. But this is your house, and they're betting you won't look. So don't let them win that bet. Watch this one next. God loves you, and so do I. Take care.